Hello, everyone. I'm Wayman Williams with Carrollton Bank. I'm a home loan officer and community development officer, and I'd like to welcome you all to this evening's home buying workshop. Okay, in this workshop, we're going to cover mortgage loan basics, FHA features and benefits. We're going to talk about down payment assistance and also explore the home buying process. First question, what are the steps to obtaining a home loan? You want to review your free credit report. That can be done through www.annualcreditreport.com. The three credit reporting agencies are TransUnion, Equifax, and Experian. You want to know your financial picture. Complete a budget and know what payment will fit within that budget. Who uses credit scores? Credit unions, banks, they're used for approval and loan terms. Insurance companies, auto, life, and health insurance. Landlords, utilities, and cell phone companies that can determine the amount of the deposit that would be required. Employers, that's also used for the hiring process. What are some factors and weighting as far as your credit score is concerned? 35% of your credit score consists of the payment history, which is your past payment history. 30% is the capacity, which is the amount owed on revolving credit. 15% is the length of time that you've had credit, so the age of new credit and your total credit history. 10% is the accumulation, so new credit and any inquiries that are out there. 10% also makes up the types of credit used, whether it's going to be installment, revolving, mortgage, and other types of credit. Okay, what we have here is a flyer. It's titled, Are Your Ducks in a Row? And what you have on this flyer is a number of things that you can do to get yourself prepared for the home buying process. Okay, if you do have a home that you're wanting to sell, make sure that you will be having enough money to make your rent payments. And next we'll talk about pre-qualification. And what that involves is how much money the lender will loan you, what purchase price you can afford, how much down payment you will require, your estimated total monthly payment. Now, the pre-qualification is not a guarantee. It is simply a pre-qualification which gives you this information listed here. The steps to obtaining a home loan. First, you want to apply for the loan. You want to provide the documentation for the pre-qualification, which is going to consist of your income and asset documents. Once you have been pre-qualified, you want to find a home and agree to a sales contract, which is going to include the price of the home, the time of the closing, and whether or not there'll be any seller concessions. Once you find a home and you have that sales contract, that's when your file goes to underwriting for review and final approval. Once your loan is finally approved, you go on to loan closing and owning your home. Okay, so as far as obtaining your pre-qualification, here's some steps that are involved in that. You're going to discuss your loan options and fees with your loan officer or loan representative. You're going to review all information with the lender, agree to the terms of a loan, which includes the length of time, the interest rate, and any points that are associated with the loan. You're going to sign the application and the loan disclosures, provide copies of those required documents again, which is going to include your income documents, pay stubs, tax returns, bank statements, and any other information that the underwriter may require. You also want to discuss the available loan programs with your loan representative. Here's some examples of different loan programs that we work with. FHA, which is the Federal Housing Authority. VA, that's for the Veterans Administration. Those loans are reserved exclusively for individuals who are actively in the military or have been in the military. And it also goes to the surviving spouse as well. There are government-sponsored loans, such as Fannie Mae and Freddie Mac. Also, their portfolio programs through banks and credit unions. Okay, the first loan program that we'll talk about is the FHA mortgage, which is sometimes considered a first-time home buyer loan. The reason being is because it typically requires the lowest down payment of any of the loan programs that are out there. The minimum down payment requirement for an FHA loan is going to be 3.5% for home purchases, and you may be able to go as low as a 580 credit score. There are less strict underwriting factors when underwriting this loan. Some examples of bankruptcy guidelines. If you have a Chapter 7 bankruptcy, you can be eligible for FHA financing after 2 years of the discharge. If you have a Chapter 13 bankruptcy, you can be eligible for FHA financing after 1 year and satisfactory repayment of those debts. Some other features of the FHA loan are going to be upfront mortgage insurance premium, which is required on all loans, and then their monthly mortgage insurance premiums, which stay on the FHA loan for the life of the loan. Also, one other feature is that if you had a home previously and that home was foreclosed on, you may be eligible for FHA financing 3 years after the foreclosure completion date. What we'll do is we'll compare the FHA loan to the conventional loan. Conventional loan can require anywhere from 3 to 20% down payment on purchases, and typically you have to have at least a 620 credit score. There are pretty strict underwriting guidelines for conventional loans. For example, the bankruptcy guidelines for a conventional loan, there has to be a 4-year waiting period after a Chapter 7 bankruptcy compared to 2 years for the FHA loan. And for a Chapter 13, there's a 2-year waiting period along with the satisfactory repayment, whereas with the FHA loan, it's a 1 year. There is no upfront mortgage insurance premium, so conventional loans are a little bit less expensive than FHA loans. Monthly mortgage insurance only applies on a conventional loan if you have less than a 20% down payment. And once you reach the 78 to 80% loan to value threshold for a conventional loan, if you have had private mortgage insurance, that's when that mortgage insurance should drop from the loan. Mortgage insurance is insurance for the lender in the event that the loan is defaulted on. A portion of that money goes to cover that mortgage loan. One other difference between conventional and FHA loans is with conventional loans, if you've had a short sale, you can be eligible for conventional financing 2 years after the completion date. Now, here's some benefits of the FHA loans. Low down payment. Again, the minimum down payment is going to be 3.5%. There are lower interest rate options available even with a lower credit score. You are eligible for gift financing for the entire 3.5% down payment on an FHA loan. Down payment assistance programs are permitted for FHA loans. We're going to talk about benefits of the conventional loans. Again, there's no mortgage insurance when you have a 20% down payment, and there are lower costs in most cases because, again, you do not have that upfront mortgage insurance premium, which is required for FHA loans. Next, we'll talk about our down payment assistance programs. One thing that the down payment assistance programs have to be, they have to be issued through HUD-approved agencies, which are nonprofit organizations and government agencies who have agreed to the terms of the down payment assistance programs. There's our Down Payment Plus program, which is sponsored by the Federal Loan Home Bank. There are also state programs for Illinois, IHDA, which is the Illinois Housing Development Association. And in Missouri, you have MHDC, which is the Missouri Housing Development Corporation. And what both of those programs offer is down payment assistance towards and closing cost assistance. Typically, they offer up to 4% of the purchase price towards those down payment and closing costs. Those are in the form of forgivable second mortgages, which are listed on title. For the IHDA program and the MHDC program, those liens stay on title typically for 10 years and then they drop off. If you sell your home prior to that 10-year time frame, or in a lot of cases for the Down Payment Plus programs, they're on title for 5 years, then that particular amount is prorated if you sell before either the 5 or 10-year period. Those loan programs are available in the city and the county, and again in Illinois. And typically for those programs, you need a middle score of at least a 640. Here's a website that offers other assistance programs. You can take a look at that when you have a moment. If you do have questions about down payment assistance and closing cost assistance programs, I would always recommend checking with your lender for that. They should be able to provide that information for you. One thing about those down payment assistance programs, most of them do have income limits, and those income limits will be discussed a little bit later. Okay, so here's some guidelines that are associated with the down payment assistance programs. Homebuyers must meet income eligibility requirements. Those requirements are set forth by HUD, and all of the nonprofit organizations as well as the banks have to follow those guidelines for any HUD-approved down payment assistance programs. Most cases, you have to contribute at least $1,000 to the purchase of the home. That's going to be the buyer's contribution. You have to participate in home buyer and financial literacy counseling through HUD-approved agencies, and you must live in the home as your primary residence. You can qualify for as little as $3,000 and up to $15,000 in funds. In most cases, those funds from the nonprofit agencies are able to be used in conjunction with other down payment assistance programs if you do qualify. Here's one of the programs that we do offer. We offer a down payment assistance program that offers $6,000 towards the purchase of your home. You do again have to meet the minimum HUD income limits. This is a Carrollton Bank sponsored program, and as long as you do meet those HUD income limits, you will qualify for this program. Also, Carrollton Bank, we do offer a 100% first-time homebuyer program, and what that means is that you do not have to have a down payment. Your minimum contribution for this program must be 1% of the loan amount. There are no income limits that you have to meet. This is a Carrollton Bank portfolio program. If you have a 680 credit score, your debt to income ratio can be 41%. If you have a 700 credit score, we're able to go up to a 45% debt to income ratio. So this is a great 100% first-time home buyer program that you can qualify for with Carrollton Bank. If you do meet the HUD income limits for down payment assistance, that can also be used in conjunction with this program. So next, what we'll do is we'll talk about those income limits. These are going to be the HUD Homeownership Program Annual Income Eligibility Guidelines. So if you take a look at each bullet point, what you have on the left side is your household size. So for a household size of 1, your maximum income can be $53,150. As you go down, you see the income limits increase. So as long as your household income meets those guidelines, then you can be eligible for down payment assistance. These guidelines are as of May 2022. The income limits are set by the U.S. Department of Housing and Urban Development and are subject to change. Typically, these change every year, every couple of years, and they do go up every year, or when they do change. Another down payment assistance programs that is offered, this is going to be the MHDC program. This is Missouri Housing Development Corporation, and again, what this does is it offers 4% of the purchase price towards down payment assistance. If that's something that you're interested in, I would recommend speaking to your loan officer or loan representative in regards to that. So next, what we'll do is we'll cover some home buyer vocabulary. Offer, what that is, that's an agreement between a buyer and a seller to purchase real estate, also referred to as a sales contract. Next term is contingent. An offer has been accepted. Finalization of the closing can be contingent on certain terms, i.e. the inspection of the home, the appraisal of the home. It can also be contingent on you selling your existing home if you are a current homeowner. Inspection, very important. This is the examination of the home for its condition, handled by a licensed professional of your choosing. So the buyer is able to choose who they want to be their inspector. What that inspector does is he goes through the home, examines the home for its overall condition. They're going to issue a report to you, which is going to let you know their opinion of the overall condition. And it's highly recommended that all home buyers get a home inspection so that you do know what's going on with your home. Closing costs. These are fees that are paid the day of closing by both sellers and buyers. These fees can cover lender expenses, taxes, and insurance. Title. That's the bundle of rights for a property, which will be handed to you by the title company to accept. Anytime you purchase a home, your title will be clear. The title company will ensure that your title is clear, meaning that there are no liens or encumbrances on the title. You are listed as the sole owner, or if you are married, then you and your spouse are listed as the owner. We'll talk about out-of-pocket costs. Earnest money. That is the money that you initially put towards the purchase of the home when you write the sales contract. That can be as little as $500 and as much as $5,000. It's really up to you and your agent how you negotiate that with the seller of the home. The inspection, that's an out-of-pocket cost by the buyer. The appraisal, that's a cost that the buyer is responsible for as well. What we have here is just some examples of different homes that could be listed, have been listed previously, and we'll go over some payment information in regards to those homes and some potential rate information. So what we have there, this is just a home that was listed at one time for $95,000. Another home that was probably listed for about $180,000. And finally, this home that is listed at $210,000. And what we'll do is we'll just talk about some payment options that could be available for those homes. What we're using at this point is a 5.875 interest rate, which is a little bit dated for today. We're also assuming 2% closing costs. That $95,000 sales price monthly payment would be right at approximately $561.96, plus the taxes and insurance. Minimum down payment, as you see that number there. So that kind of indicates for that first home, your total kind of out-of-pocket expense should be right at about $5,225. Same type of numbers for that second scenario, giving you an example of what that payment could be. Same thing for that third option. Again, just telling you what that minimum down payment would be, total out-of-pocket expenditure for the buyer. So next to last slide, we'll cover the 10 commandments of buying a home. Here's some things that we as loan officers kind of recommend to our buyers. Thou shalt not change jobs, become self-employed, or quit your job. That's something that can complicate the loan process because we may need to wait until you've been at your employer for a certain amount of time before we can continue with the loan. You should not buy a car, truck, van, or motorcycle. I would just like to add to that, you probably should not initiate any inquiries on your credit. You want to keep things as simple as possible. You want your credit to match what it was at the time of application, unless there's an opportunity for you to improve some things. Thou shalt not use credit cards excessively or let current accounts fall behind. By using credit cards excessively, you could impact your debt to income ratio, which could impact the amount of the home you're able to purchase. You allow those accounts to fall behind. That can cause your credit score to drop and could possibly prevent you from purchasing a home. You should not spend money you have set aside for closing. Any money that you've saved and set aside, you want to keep that in the savings so that you have that money available for closing. You should not omit debts, liabilities from your loan application. That can only complicate things because each bank is going to have to check your credit. They're going to see the debts that are out there, and they'll have to acknowledge and reconcile those debts. You should not buy any furniture. Try to avoid any major purchases while you're going through the home buying process, because again, that can impact your credit. It can impact your debt to income ratio, which again can affect your ability to purchase. You should not originate any inquiries into your credit, because any inquiries have to be addressed. If there's new credit obtained, that has to be addressed as well. You should not make large deposits without checking with your loan officer. Any large deposits that are made into your savings account or any account that is being used for the purchase transaction is going to have to be addressed. So if at all possible, avoid any large deposits. You should not transfer funds or change bank accounts. That can only complicate things. You want to keep things as simple as possible for underwriting and your loan officer. If there's a mandatory need to make changes, consult with your loan officer or loan representative to make sure that that's okay. You should not co-sign on a loan for anyone, because when you co-sign on a loan, that's actually your loan. If that loan is defaulted upon, you're going to be looked to have to pay that loan, and it's going to impact your credit. This last slide here, we're just going to talk a little bit about generational wealth, which is also called family wealth or multi-generational wealth or legacy wealth. It's wealth that is passed down from one generation to another. You build generational wealth by acquiring generational assets that you can leave to your heirs. Assets are anything you own that make you money rather than take money out of your pocket. And probably the biggest asset that anyone will ever purchase is going to be their home. And the goal would be to pay that home off, pass it down to your heirs, your children, maybe give them a jump start in life. That can be their home, or they're able to do anything that they like with that can really kind of set them up for the future. At this time, if we have any questions, I'll be glad to answer those. Mm-hmm.
Pre-qualifying process, is that different with different loan officers, or is it pretty standard across the board?
Well, it can be different with different loan officers. What I recommend is providing any and all income documents that are necessary. That way you're going to get a solid pre-approval or pre-qualification. Those terms are really, they're one and the same with our bank, because we do ask for income documents up front, but on the market, apparently there are pre-qualifications that don't involve income documents and really vetting the buyer. I would always recommend providing all income and asset documents up front so that you know you have a solid pre-qualification.
So you made a lot of recommendations as to how to put yourself in a position to buy a house. If somebody's not quite there, would you recommend that they reach out to yourself and say, okay, can you help me on a step-by-step basis get there? Or how much involvement do you guys have when somebody's not quite ready to purchase a house?
Okay. Well, if you're looking to purchase a home and you haven't quite started or are unsure if you really want to get started at this time, I recommend going ahead, getting with a loan officer, loan representative, having them check your credit, get your income documents so that you know where you stand, because there may be an opportunity to improve things. I can tell you that if I have an individual that is not quite ready to purchase from a credit perspective, then what I'm going to do is work with them, advise them on what needs to be done to get themselves more prepared to purchase. So I would always recommend applying, knowing where you stand so that you have an opportunity to improve. Mm-hmm.